Morning, everyone. Speaking a bit louder because we were standing at the back, we could hardly hear what she was saying. Right, so today we're going to do a quick chat on sort of what the market's doing in the venture and capital scene. I've got a really, really good panel here today with me. I'm just going to quickly jump into it and we just do a round of intros. Why don't we start with you, Roo? Just tell the audience within 30 seconds to a minute, just about you, your brand, and sort of what you're looking for.
Sure. You'll hear me? Yep. Great. Hi, everyone. My name is Roo Harris, partner at Scale Investors. I like to introduce myself as the recovering lawyer, having escaped after a 20-year term. Most of my career was actually in the Middle East, where I ultimately ended up working for the ruling family of Qatar, doing their cross-border transactions and investments. That led me to venture deals and impact investing, and the rest, as they like to say, is history. Now partner at Scale Investors, where we invest into women-led startups. We have been an angel syndicate for 12 years in market. However, myself and a couple of others bought the business out in a management buyout 2 years ago. We like to invest in women because they are overlooked yet outperforming. I like to think they're the best kept secret in venture. And that ultimately they bring really unique perspectives to solve challenges for really vast and underserved female markets. And then if you add in the phenomenal transition of wealth into the hands of women over the next 10 years, it makes it for a very interesting opportunity, we think. We've invested in 50 women-led startup investments. We've had a couple of great exits. We've got a strong existing portfolio, several in there performing very strongly, which we're now raising a fund to take advantage of those and invest into sort of certain select top performers. We're raising 100 million, currently at 25 mil, with 3 very high-profile cornerstone investors confirmed, including Minderoo Impact Fund. I'll pause there.
Hello. Yep. Hi, I'm Danin Khan from Electrifi Ventures. I've been an entrepreneur and on the operator side for most of my career. I started doing personal investing in the climate space. I come from a background being in climate and energy and renewables. Saw a lot of opportunities and started personally investing, and then set up Electrifi Ventures, which is essentially a syndicate to back leading climate tech businesses. So we raise capital from individuals, high net worths, and family offices.
Hi everyone, my name is Kevin Wilson. I'm a partner at OIF Ventures. My background is in investment banking, where I was for about 2 decades. And most recently I was at Xero as head of corp dev doing acquisitions. And I've been at OIF for 2.5 years. Although the fund is about, there's 4 funds and we started about 8 years ago. I came on board to complement the early stage investment thesis of the first 3 funds, which is really from first revenue through to about 5 or 6 mil of ARR. And I came on board 2.5 years ago to raise a growth fund, which is around 10 mil of ARR businesses and onwards. And we focus mainly on B2B software companies. And all of our investors are individuals, family offices, and execs. And that's really our differentiator, is that we've got really highly strategic people who invest with us and help our portfolio companies. We've got 48 portfolio companies across the 4 funds that we have. And the fund that I run, the growth fund, we've got 6 investments currently. And really happy to be here. Thank you.
Thanks, guys. And I'm Amit Varma from the ASX. Senior manager with the listings team, and my role over there is to look for the right types of companies to list on the ASX at the right time, and I do that across Australia, New Zealand, Singapore, North America, and that's the US and Canada, and with a focus on tech and VC-backed companies and also healthcare. Right, and then apart from that, I'm very actively involved in the early stage space as well for the last 10 to 15 years. I've got about 30 investments of my own. I mentor companies at 2 accelerators and also a part of a few syndicates and LP positions in funds as well. So very actively involved in that space as well. All right, so let's get straight into it. The reason we're here today is obviously, we've seen so much of stuff happen in the last 12 months with private capital. On one side, you've seen material investments going into AI and AI-led startups. And on the other side, you've seen stuff like, number of down rounds increasing. So what's the valuation doing? So there's a lot of stuff to talk about today. But before that, let me ask a quick question. Take a quick poll. How many founders or CEOs in the room here? Put your hand up. Perfect. How many of you are raising money in the next 12 months? So quite a few. And how many investors in the room? Quite a few as well. So there's a decent mix of folks in the room to talk about. So let me just quickly start with you, Roo, and then we come this way. From your perspective, from scale investors' perspective, what are you seeing? What's the current state of the venture market from your perspective?
Am I on again? Yep. So we've certainly seen, we had 21, 22 and everything was pretty dandy. And then we've had a real reset, is how I would describe it. And so that's definitely, impacted the very early stages where we sit. I think capital is still really hard to come by for founders at the moment, and that they can expect a far longer journey on their raise than perhaps would have been the case a couple of years back. I do think the recalibration, though, in many ways is good. I think there's a really strong focus on quality and sort of fundamentals and essentials. And if you can prove those things out, then investors are still going to, look at you seriously. What else?
Danin, what about you? You obviously run a syndicate opposed to a fund, and you've got a clear thematic.
I do. So it's in climate. So probably where we're slightly different to a lot of funds is, it's the Australian sort of venture ecosystem has been set up on predominantly funding B2B software companies, or at least SaaS companies. And in the climate space, we obviously look for great software companies, but also realizing that the world's not just going to decarbonize with software. Electrons don't move around just through software. There is hardware, all the sort of stuff. So we have a slightly different lens on it in that some hardware, especially deep tech and these new innovations, can have quite a long horizon to grow, and sometimes they don't have revenue for a while. They jump up. So it's a slightly different view. It's a longer term view. We see a bit of a, I won't call it a resurgence, but a bit of a groundswell in deep tech and advanced manufacturing. A lot of this is in the climate space, some of it not. And where we're playing, where we see a very distinct advantage, and we think Australia has an unfair global advantage, is in what we call grid tech. So we have the most advanced electricity grid in the world with the highest penetration of rooftop solar and batteries, and that's creating a lot of need to operate the grid differently. And so there's companies here that can build, like one of our portfolio companies, Amber Electric, that has built an incredible retail platform and now taking that platform overseas to retailers. So we see very positive and optimistic landscape. I think the AI hype bubble, which we'll probably get to in a sec, is maybe distorting some of it, but maybe I'll leave that for...
Yeah. And Kevin, coming from OIF's perspective, obviously you focus historically more on B2B SaaS and mostly enterprise SaaS. So, and you're part of the growth side of the things. So what are you seeing in that space?
We've seen it really positively at the moment. From the stage that we're at, and I'll talk from the growth fund perspective. We've got an 80 mil fund, and we write checks of between 5 and 10 mil in businesses, which is probably the stage before two things. Like for most of our companies, either they're going to go and find a big US investor to help them scale into the US or scale overseas, and it's probably too early for them to go and get that capital now. And we can really help them do that. So if they've got 10 mil of ARR, they may be sort of already 1 to 4 mil of ARR from overseas, but we'll help them, get that to, above 10, which is when the US tier 1 investors start looking, or we get the business to cash flow positive, and potentially both of those things. To which point they don't actually need any further funding, and we can our exit horizons in about 3 to 5 years, we generally say. So it's kind of a private equity type exit horizon at a later stage, but we only take minority investments, if that makes sense.
Maybe I might stick with you, and since obviously we're talking about deal flow, and there are a bunch of folks in the room that are potentially raising right now, what are you seeing with, and I'll come to you guys in a minute as well, what are you seeing with valuations? Obviously, the number of down rounds has increased in the last 12 months. Often it's a case where there's potentially an overhang from, if the company is long enough and raised in 2020 or 2021, some of those multiples were pretty crazy, and then there's a bit of an overhang there, and hence why potentially the companies haven't grown into those numbers. And what are you seeing from that angle, not just with your portfolio, but new deals coming to you? How are you seeing the pricing for those?
I think they're reasonably priced. I think the sort of days of 2021 are behind us. we model these companies because they are at a point at that 10 mil stage where you can actually model out a sort of 4 or 5 year scenario, and we'll model that out and we look at what our entry multiple was and then a potential exit multiple, which we'll use comps. So you're at that point where you can actually use comps. Whereas at a much earlier stage, it's much harder to do that, and there's just much more uncertainty. But my fund is an IRR fund, so time matters as well. So we'll look at generally a 4 or 5 year exit horizon for the exit, maybe usually 5 just to be safe. And then we'll see if we can try and get a 30% IRR is what we aim for with some buffer. And yeah, that's kind of how we do it, and then sort of reverse engineer what that means for a reasonable multiple. But we don't sort of get, like, valuation is important to us. We don't have FOMO on missing out deals because the valuation is too high. We're very happy to walk away from deals because there's just too much risk involved, and that goes to investing at too high a valuation.
Thanks. And Danin, obviously your thematic is a bit different. The cost for the fundamental cost base of companies coming to you potentially is different from companies that might be going to Kevin or Roo because they're software only. How do you assess that?
We do look at software and hardware companies. I think globally markets are being distorted now. There's obviously a crazy AI bubble going on, and you're seeing companies like scale revenue incredibly quickly. So there's a bit of a shift, and that's probably proving challenging for some SaaS companies that have kind of gone maybe more of a traditional route. So I think there's still a big question as to how sustainable some of that very high leverage, high growth AI revenue is. I think with valuations, one thing that we kind of play on quite heavily, and we do have, because we're a syndicate, we have investors on a deal by deal basis, and we have majority of our investors are in Australia, but we do have investors from overseas, and we think there's a massive valuation arbitrage in terms of the same company that's might be setting up here with the same skills or the same team talent or whatever else, and you might have the same company setting up in North America that might be 3, 4, 5 times valuation. They've obviously got a bigger market right at the doorstep, but I think the key is how can we get these Australian companies selling overseas quickly. Yeah.
And Roo, obviously with your specific thematic of female founders, have you noticed any nuance with that? Is there a difference? Do women undersell themselves or oversell, or so? How do you see the pricing there?
I'll make a couple of points on that front. But firstly, what we're seeing is an extraordinary democratisation and access to technology. So where women may have traditionally not had the same numbers in STEM, suddenly their ability to come in as an entrepreneur is completely democratised. We do know, for example, that the data on vibe coding is that women are vibe coding at the same rates as men. And a lot of people think there is no women-led pipeline, which is absolutely not the case. We are inundated with it, just drowning in it constantly. But I would say that in the last 6 months, what we're seeing is effectively AI as a co-founder for these women that we're meeting with, and so that's shot up the quality of the deals, but also the time frame for them getting to a point where they can actually receive investment, even though they might have only been founded a short time ago. So there's a whole lot of interesting things tied up in that, and for me, where it lands me is that defensibility in an AI age is absolutely everything, because if you can create this tech business as quickly as what we're seeing, businesses come through, then I really need to know that your data is, proprietary, that there's a hardware piece to it, that there's some kind of, proprietary channel to market that no one else can access, whatever it might be, because otherwise it's just a sea of fabulous deals. And so I'm more interested in that than I ever was. I don't know if that was really an answer to your question. I sort of went on a tangent.
And look, we've already mentioned AI about 6 times in the first 5 minutes of the discussion. I'm just going to stick with that thematic. Obviously, we only have about 20 minutes left, so I want to probe on this a bit. But before that, another quick poll. How many in the room are running a tech software business with no AI element in it? See, no hands up, right? So everyone now has something to do with AI in their business. So obviously, let's just probably probe a bit more into the hype versus reality. I see a bunch of AI-led deals come to me, and then obviously I've got to way to sort of filter, whether you're playing in the infrastructure layer or the model layer or the tooling or application layer, and then you see potentially where the value is going to accrue, because you've got a couple of layers dominated by big players in the market anyways. Kevin, two questions. How do you look at a new AI deal that comes to you? And the second thing is, existing companies in your portfolio that may not have had any AI element 10 years ago, although you're new in the fund, but still legacy companies, what are they doing to basically adapt? Or do they have to adapt? Let's go with how do you assess new stuff coming in first? Yeah.
So I think that we always look at the company coming in and look at how it could potentially be disrupted by AI. I think that when you say a company is an AI company, I think your point earlier is, like all tech companies are now, either AI or trying to be AI. I'll maybe try and meld those two questions together in a way, because our portfolio companies are doing the same. Like if they have an old tech stack, maybe a legacy stack, or even if it's modern or what was modern was a year ago, they are exploring basically rebuilding their entire tech stacks on AI. And some of them have done it in different ways. Some of them have looked at how do they actually literally rebuild the whole thing, and they can do that. Something that used to take sort of 4 years could now take 6 months. So they're looking at doing that. And then secondly, I think that they're looking at really like new products. So how could they be more efficient at building their tech stack, building new products? Well, another example is another company is building a new product in a separate app, and it's sort of like an adjacent product to what they have. And then they're actually going to build the core product back into that, which is quite an interesting way to do it. But I think all of our companies are exploring AI in terms of how they can be more efficient, how the tech could be better, and then also how they could manifest that AI in the product itself to allow customers to have a better experience, if that makes sense.
And Danin, in your thematic, what role does AI play? I mean, are you seeing lots of companies without AI elements coming to you, or no?
Yeah, we have been. I think it's on the hardware side, it's becoming more and more. So I think you can do experiments quicker. You can do a lot more stuff now with AI. So starters who are working in hardware or deep tech that are looking at this sort of stuff and they're not using AI, I think they're going to get left behind. Definitely. I mean, you were saying that implementing AI into the tech stack as your own product is a direction where a company's going to need to go, but also just the way companies operate their general services. So I think we're looking at the capital efficiency now of companies and making sure that they don't have unnecessary stuff, that they're implementing this throughout the operation, so they can become more capital efficient.
Roo, any comments from you on that?
I might just extend and take AI into the due diligence process, if that's okay, because that's what I've been particularly focused on, I guess, in recent months. For us, we are not using it hugely in the screening stage. We do invest very early stage. And while there is a whole lot that you can codify, and we know that the average age of a successful founder is 42, and the profile of the founder of a unicorn is that they're an underrepresented group with no plan B and a chip on their shoulder. We know all of these things, and we can feed that into a high-level screening process. But at this point, our central focus is actually the sort of bulk of the due diligence process and bringing together vast amounts of unstructured data into sort of first drafts of things, being very clear about. So we've written our own, AI agents that effectively we make very clear that we don't want their opinion. We just want that data collection piece, because we all know that AI can have some pretty crazy hallucinations still. So we're fiddling with that and going on a journey around all of that and how it works. I wouldn't say that we're there yet and it's brilliant and perfect, but it is radically reducing the amount of time that we do need to spend on an individual deal. And then you've got the portfolio stage of things where we're only just sort of starting to sort of explore that. But the piece I'm really excited for in terms of implementing AI into that stage of things is around like M&A analysis and opportunity and connecting that in with portfolio companies and thinking really strategically about how we make that work. So there's still lots of work to do, but I think it's good to be having the conversation and talking about it, sort of one investor to another, to understand how we all kind of grapple with this together. And it's certainly exciting. It is hard for the next gen coming through because we thought we'd have to hire a big team for this next fund, and I just don't think that's going to be the case anymore.
Thanks, Roo. And since you brought up due diligence, let's maybe stick to that. Not so much as whether you guys are using AI to do your due diligence, but because we've got a bunch of folks in the room that are potentially raising, and they will obviously, some of them could send you guys their pitch decks, and maybe you like some of them, you start doing due diligence. What should these companies be focusing on? What are the biggest areas where folks trip up when you guys are doing due diligence on them? We all have seen the traditional competitor slides where the company that's pitching is always in the top right quadrant. We've always, depending on what parameters you choose, we've always seen the projection slide where you're always going to be $100 million revenue in the next 3 years, right? It always works like that. So apart from those very, very obvious things, what are some of the things that folks should be aware of? Maybe I'll start with you, Kevin.
I mean, I think at its core, it's having a good pitch pack that answers kind of all the obvious questions, and then I think next to that, it's having a good financial model that's been well thought out, that ties to everything that's in the pack, and then has 2 or 3 years of forecasts that have just very, it's built up with assumptions that make sense, I'd say.
Can I just jump in there for a second? Obviously, are you talking from a more growth state perspective where forecasts are probably more meaningful versus someone that's potentially pre-revenue? Like, what do they forecast? I mean, often that forecast is completely meaningless.
Yeah, I'm sort of talking from that sort of 10 mil ARR stage, so the business is significantly more mature, and then really sort of thinking about what the drivers of your future growth are, and just having those assumptions, basically in the model. And, so what I was saying earlier is we will model out returns and look at what year we're going to exit. And then we'll look at what we need to believe in that time that the business needs to achieve at its very core, and generally build a bit of buffer into that as well. So that's sort of the core of it. I think the most important part of our DD outside of the financials is actually just speaking to customers. So we speak to a lot of customers. In one case, we spoke to 50% of accounted for 50% of the revenue actually by customers. You can learn a lot about the products and a lot about the, just future churn and that sort of thing from speaking to customers. So investing the time and speaking to, if you can't speak to as much as 50% of the revenue, at least obviously select the sample yourself and speak to those customers at least 5 or 6, 30 minutes each. So what would I say to founders? I mean, I think if you've got a great product and you're giving a great service, then those customers are going to say great things about your product. I don't think it's too invasive. Generally, how we'll start the conversation is by saying, we're looking to invest money in this product because we love the product, and this money is going to go towards improving the product and improving your customer experience. So, hopefully we're aligned here, and generally that's fairly well received, and we can generally have a great conversation. In most cases, we'll share the notes with the founders, and they actually learn a lot about their customers as well. So it's generally win-win. And the other thing we do, is we make introductions. So we'll make introductions for future customers that may or may not be in their pipeline, and we'll often make the live introduction on a call, so then we can see how the founder or the sales team actually sells the product. And then if we know the customer, because they may in fact be one of our investors, we can back channel with them and understand what they could do better. And then it's also win-win because hopefully they then have a customer after that if they can win that customer. So
sure, thanks. And I think that's an important distinction on the stage of company doing forecasts or financial projection, the financial modeling. Obviously, 10 million ARR, you'll expect your financial model to be fairly robust from a projection perspective. But if you're a pre-revenue company or companies that are doing 100K a year in revenue, it's very hard for it to sort of any material projection that makes sense. And often what investors would do is they're more interested in the thought process that goes into building that model versus what the numbers in year 3 or year 4 are, which I can guarantee you the numbers are 100% wrong. Whatever you project is not right for year 3 or year 4. It's more important is what are those assumptions that you guys are using? What is the thought process that's gone into building the model? How realistic are you? And I think sort of that's the way how I look at it. Danin, from any point from you on due diligence?
Yeah, I'd like to add a couple of things there. So we're stage agnostic. So we're investing on pre-seed, which could be first money into Series B or even slightly later. But what I think, we still get emails all the time. They're unsolicited emails that come through with pitch decks and whatever. They're generic. And I just think like that is like in the age of AI, that's just criminal. It's so easy to, throw something into an AI software and say, find the funds that align with what I'm doing, tailor something, make it specific. So I think I'm astounded that still happens. And then just I think for a bit of deeper reference, something that we do, and it's very simple to do. We're also building a lot of AI tools in terms of managing our process so we can be more efficient, get through more deal flow. But there's so much, especially when you're investing early stage, so much of it is around the team and what drives that team, what's going to make that team be successful. And it's actually, without taking the opinions of the software out, it's actually very easy to take all the transcripts with different stakeholders, different founder engagements, all that sort of stuff. And you can quite easily start to see trends, similarities, conflicts, or anything like discrepancies in that data. So I think if you're a founder and you're going through a process now, you should expect that the more authentic you can be, the more open you can be, the more transparent and the more aligned you're finding investors, the better traction you're going to get, because it's going to be so easy now. It is so easy just to weed out any inconsistencies, all that sort of stuff. So I think that's something to be mindful of.
Thanks, Dan. And look, I know we're coming close to time. I'm going to maybe take an extra 5 to 7 minutes. I do want to come to the audience for a couple of questions. So whoever's thinking of a question, put your hand up soon. But before that, Roo, from a due diligence perspective, what have you seen? What are the biggest mistakes folks make?
From the founder perspective or from other...
From the founder perspective.
Look, I think at the very early stages, it is hard to be steely focused on an exit when you're very new. But from the investor point of view, we're definitely thinking critically about what is the potential pathway for exit for this particular business. And to the extent that you can sort of, properly develop a narrative around that. And look, we encourage, our founders to really identify their sort of ecosystem of natural acquirers right from the get-go and be having quarterly calls with them. And if you can demonstrate that you really understand that this is an investment for the investor, it goes a very long way, because I can't tell you the number of people that I meet with who have a great concept, great idea, they've got some good traction, but they've never actually turned their mind to how it's going to make a return for the investor. It's a simple thing, but it does appear a lot. Thanks.
And I obviously, with my day job, I can help with exits as well. So obviously, we know globally only about 10 to 15% of VC portfolios do end up going to IPO. The majority of them end up either being acquired or, unfortunately, some don't make it. So there's a variety of ways to exit. And of course now, more recently, with the rise of secondary funds and secondary money available to sort of clean up the cap table, take out some of the older investors, those options are just sort of increasing and getting better. Right, who's got a question? There you go. Well, I'm going to start with the biggest differentiated one, right? There's two sitting here with a quite differentiated. One does women only and one does energy and clean thematic. So talk about differentiation, Danin.
Yeah, I think we're differentiated. We're operators that have come from the space in the clean energy and climate space. And so we understand the markets. We can introduce networks. So as a founder, I think we can bring value in the sense that we've been operators, we can bring networks, we can bring expertise, domain expertise, and really take a more hands-on approach. I think capital is somewhat commoditized, But I still think, I mean, I don't want to underplay it. There's a huge amount of startups out there looking for capital that can't get it. So it is still pretty hard for some.
Thanks. And Roo, we literally have a minute left, so do you want to quickly comment on your area of differentiation?
Yeah, I hope I'm less differentiated, and in the sense that, there's more of me out there. I think the challenge is that fundamentally, investors bring bias to what they're doing. And at the moment, the investment decision makers in the venture space and along the investment spectrum are predominantly men. And we know that women fund managers are more likely to actually fund women. So last quarter, female-led venture got 0.2% of venture capital funding.
Appalling.
It's appalling, but also there's the wild opportunity, right? Because we know that diverse teams outperform, and that women-led teams do exceptionally well and actually have 35% higher returns on investment, higher cumulative revenues, they're more capital efficient. There's a whole lot of data around their outperformance. So it really is this incredible arbitrage opportunity. But I think as we slowly see female-led investment firms coming into the market, then we will also see more women getting funded. But it's a longer-term play, and we'll be going further down the diversity stack probably over time, so they can try and catch up if they like. We'd love to have them join us.
Roo raises such a good point. When I got into this game about 10 years ago, there was literally only Michelle Decker and then Andrea Gardner running a syndicate, and then Sam Wong came on pretty quickly as Blackbird, and literally there was no one else. And it's been so good to see, although we're still far away from having a large number of women as in partner roles. We've seen the growth of women in junior and mid roles, but we need to see, as Roo said, more women in partner roles and managing partner roles, which should hopefully increase the amount of funding that go to women startups, which the stats show that they generally have better outcomes. But anyways, we've just been kicked off stage, so I'm going to end this now. Come and find us outside if you want to have a chat or any questions. Reach out on LinkedIn if you want to have any further contact. But please join me in thanking this wonderful panel, and thank you all for joining.